Many of you are currently using aggregators to trade your STCs. If so, this video is a must watch. We'll show you how our pricing and fees compare with traditional aggregators, as well as how the 2013 market is currently performing. By the end, we're confident you'll see the financial advantages of using FormBay Trading. To understand the difference between how FormBay Trading and aggregators operate, we must first understand how STCs are created. Specifically, there are 4 critical stages. In stage 1, the STC form is created and filled out. In stage 2, the form is uploaded to the CER. In stage 3, the form is then processed by the CER, and in stage 4, a tradable STC is created. This process has essentially allowed for the creation of 2 markets: a pre-created STC market, which the aggregators use, and a created market, which FormBay Trading uses, along with other big volume traders. In the pre-created market, the aggregator assumes more risk by pre-purchasing STCs that have yet to be approved by the CER. FormBay Trading, however, in the created market, only purchases STCs that have been approved by the CER. Because there's no risk of certificates being rejected, our trading partner is able to pass on the best price to us to give to you. Let's have a look at the financial advantages of using FormBay Trading in a little more detail. The difference between the spot price and that offered by the aggregator is obvious. The revenue you're missing out on is the difference between the red and the blue line. Notice that as the market rises, aggregators tend not to pass on these changes as quickly to you. Their price remains far more static, averaging out at around $2 less than what FormBay Trading can offer. With our service, market fluctuations are passed straight on to you as they happen throughout the day, minus our $1 fee. The net result is more revenue to you, even after our fees are deducted. What we will show you now is actual pricing data compiled from the 15th to the 28th of February 2013, comparing FormBay Trading directly against one of the largest and most well-known aggregators in the industry. The green icons show the difference in pricing after taking off our $1 fee. If we start on Monday the 18th, FormBay Trading's offering was $1 above, rising to a high of $1.55 by Thursday, then pulling back slightly to be a very respectable $1.50 above on Friday the 22nd. As we discussed earlier in this video, the pricing from the aggregator during the same week stayed stagnant at $30, even though the market had risen on a number of days. Only on Monday the 25th did the aggregator increase their pricing to $31. Even then, FormBay Trading was still 75 cents ahead. On Tuesday the 26th, the spot price began to rise again, while the aggregator's pricing flatlined at $31. You'll see that on the 28th, our pricing hit $33.90, leaving a massive gap of $1.90 per STC above the aggregator. On March 5, FormBay surged to a massive $2 per STC ahead, and even with the aggregator's eventual response the following day, raising their price to $32, FormBay Trading still remained $1.20 ahead. In all of these weeks, if you were still trading your STCs with an aggregator, you could have been missing out on hundreds of dollars of revenue per week, or thousands per month. As you know, the value of the STC spot price is determined by the volume of STCs in the market. Oversupply will see the price drop, while undersupply will see the price increase. The dominant factor that has created market volatility has been the yearly STC multiplier drops. Here, we are going to show you how the spot price is currently performing versus 2011 and 2012, as indicated by the blue line on the graph. In 2011, the industry was booming, with the 5 times multiplier still in place. 6 months out from the drop, solar companies aggressively advertised to customers to take advantage of the government rebate before it finished. This created a spike in the number of installs nationally, flooding the market and sending the spot price crashing before the 30th of June drop, as you'll see in red. The market stuttered as more STCs were dumped, and then again recovered slightly, causing a second mini crash in August. Again, it recovered over the next 4 months, as you see in green, but many companies were financially scarred or even forced to close their doors, having been caught out with such a massive drop. If we move on to 2012, we see the cycle repeated in the lead up to the 3 to 2 multiplier drop, resulting in a similar drop in red. However, the drop was far less severe than in 2011. The market then recovered in the lead up to Christmas 2012. What then came as a big surprise was the CER's decision to move the drop-in multiplier from 2 to 1 on the 1st of January 2013, as opposed to the 30th of June 2013. With the drop coming 6 months early, solar companies were unable to capitalise on their usual marketing push relating to getting in before the rebate finished. As you can see from the graph, this last drop had no effect on the spot price. What we hope you can take away from reviewing the 2011 and 2012 market statistics and the drop in the multiplier from 5 to 1 is that the market now has far less STCs, but a more steady supply of them. This means less volatility and more stability. Many of you will be using aggregators because of market volatility in 2011 and 2012 without realizing how the market is currently performing. Now, at the 1 times multiplier, solar companies have to show value and service in their solar offerings, not just rely on large STC rebates to hook customers. While not saying what the market will do going forward, it's clear that there is no better a time than now to reap the financial advantages of trading your own STCs, because now more than ever, every extra STC dollar counts. There are no lock-in contracts, no upfront fees, and it's super easy to get up and running. Why not give it a try on one of your upcoming installs? You've got nothing to lose and a lot to gain. Thanks for watching.